In this AMT Insight, I'm going to discuss the impact that China's zero COVID approach is having on the metals markets. Now, this has very much come back into focus since mid-March, as China has struggled to contain a fresh outbreak of the highly infectious Omicron variant. Detected cases have emerged all across China really, but Shanghai very much remains the epicenter of these cases and issue. Cases in the city have declined from mid-April as the city introduced quite strict curbs on movement from towards the end of March, but the population of 25 million still remains subject to very strict curbs on movement. Now, cities and regions elsewhere in China have introduced their own restrictions at a lower level. I think most notable of these has been strict curbs on travel between provinces and cities. Rising cases in Beijing has also stoked quite significant fears the city itself could also see the same strict measures imposed on it that Shanghai has been experiencing. So overall, these measures have severely hit trucking and logistics. They've caused a widespread supply chain turmoil. And I think as a financial response to that has been quite a sharp retreat in China's equity markets and also a pullback in global commodity prices because of the implied impacts on demand and future demand prospects in China. Now, the economic hit to China from these measures is quite clear in the PMI data that it releases. You see that the services sector contracted quite sharply in March, but the manufacturing sector also saw a contraction, and I think that data is likely to deteriorate further in April as the impact of the strict measures that have been imposed start to become a bit more clear within that data. Despite all this economic hit, policymakers are still rigidly sticking to their zero COVID approach. You still have shortages of raw materials and components that have forced manufacturers to cut operating rates. You've seen industrial hubs like the steel hub of Tangshan, the electronics production hub of Kunshan, subject to strict measures. Car manufacturers in affected regions hit both by component shortages and also concerns about terminal end-use demand. People locked down at homes, do they need to buy or want to buy a new car? And disruption, I'd say, to the metals production, conversely to that, has been, I'd say, fairly limited and, again, largely related to the logistics disruption. So you've seen some inventory stuck at smelters, scrap supply issues hitting secondary lead production, for example, and perhaps border restrictions starting to affect the flow of imports of ore and concentrate for some metals, for example. But overall, the production hit has been fairly limited. Now, the second key part of this narrative and story really has been, as a source of market pessimism, has really been the lack of concrete stimulus support for the economy as a response to this headwind from COVID restrictions. So at the beginning of 2022, I think most market commentators were largely positive and expectant that Beijing would be announcing significant policy support to bolster its economy amid a deepening property sector slowdown that you saw starting in towards the back end of 2021, but has continued in the early part of this year as well. However, I think meaningful action has failed to materialise, or at least has underwhelmed. So the People's Bank of China on the monetary policy side has pledged to maintain ample liquidity for its economy, but has kept its headline rates pretty steady. It's only made modest cuts to the cash reserves that banks are required to hold, for example. And I think part of the issue for them is really that the aggressive expected monetary policy tightening outside China by central banks like the Federal Reserve, by the Bank of England, potentially by the European Central Bank as well, really limits China's monetary policy room to cut key rates without provoking capital outflows. People might want to get a better return for their money outside China if China's suddenly cutting rates and elsewhere they're raising them. Now, policymakers continue to promise targeted fiscal support, and that has included in recent days promises for massive infrastructure spending push. But again, there's been a lack of clarity so far on the specific policies that are going to be implemented to deliver that. Now, in terms of the property market, it's been struggling, as I've said, for over the last year, really, and it remains a key headwind for the economy in isolation of what's happening really with this COVID-related slowdown. And that has implications for base metals demand. Housing starts, sales, completions, they've all remained notably weak, even into spring during what has typically been a peak season for construction demand. Now, in the past, China has very much relied on the property sector to boost growth in times of economic stress. However, in this chart, you can see population growth has stalled in recent years, and that's been a long-term trend of decline as well in terms of that growth rate. if you look at the chart here, you can see that the share of urban population in terms of the overall population has weakened substantially in terms of the increase in that share over the last 5 to 10 years. And Beijing is accordingly, because of those clear demographic trends, trying to reduce dependency on real estate as a core engine of its economic growth. So it's maintained its three red lines policy that it introduced to try and reduce debt and credit issues in that part of the economy. And I think it's unlikely to meaningfully relax those constraints, even amid this issue with Omicron and with COVID restrictions, although it may take some action to ease liquidity conditions somewhat, just to ease stress in that sector. However, I think overall the key point here on property has been that real estate's utility as an engine of emergency economic growth for Chinese policymakers is very much diminished compared to what it was in the early 2000s, I would say. So what does this all mean for base metals markets? Well, outside China, base metal markets remain very inventory constrained. You're seeing very shortages, particularly regionally in places like Europe and the US. But I think the issue is that you're now seeing these growing headwinds to global growth that are going to have some impact on the demand side. So China's zero COVID policy is clearly going to continue to undermine economic activity as the use and the threat of lockdowns persists. Even if the restrictions in Shanghai should ease somewhat, that threat, that lingering threat of a fresh COVID outbreak and a fresh imposition of restrictions is going to remain there in the lot of at least the medium term, as long as China's zero COVID policy remains in place, and there's no signs that is changing anytime soon. So targeted policy support and measures, particularly to boost infrastructure spending, may offer some limited economic relief, but I think Beijing is unlikely to rely on the property sector as a silver bullet for this slowdown. So it seems that China is pretty likely to fail to hit its 5.5% growth target for 2022 because of all these issues and because of probably relatively limited policy stimulus support, or at least not enough policy stimulus support to offset these COVID risks. Outside China, we still have monetary policy tightening, and we've got a developing cost of living crisis exacerbated by the war in Ukraine, energy price issues, for example. And it seems that China's supply chain woes are likely to add to those ex-China inflationary pressures as well. Components and goods and freight issues are likely to persist longer than would other have probably been the case. So overall, summary point for this insight really, metals are fighting a growing growth tide, growing headwinds to growth exacerbated by this Chinese COVID situation. However, individual metals, I think, can still fight this tide, particularly regionally where acute physical tightness still persists, and there's no immediate signs that that's going to be resolved either. So it's a bit of a supply-demand battle, but growth, I think, is starting to look a little bit weaker at the moment because of these headwinds that we're seeing emerge. Now that's the end of this insight. If you're finding this kind of content that we're putting out on a periodic basis interesting, encourage you to follow AMT's LinkedIn channel, and the details will be with me there. Thank you.